Welcome back to Smart Stock Sam, the channel where we cut through the noise and get straight to the trades that actually matter. If you are new here, this is where we break down real stocks with real data and real price levels that you can go and use right after watching. Hit that subscribe button so you never miss one of these. Today, we are going deep on Microsoft. And if you have been sitting on the sidelines waiting for clarity on this stock, I promise you, by the end of this video, you are going to have it. Here is the full picture up front, because Smart Stock Sam always gives you the roadmap before the ride. Microsoft just survived one of its most brutal drawdowns in modern history, a full 20% wipeout in just a few weeks. But right now, something is shifting in a big way. The cloud numbers are breaking records. The options market is screaming in one direction. The technical structure has completely flipped. And the institutional money, the people who move markets, has stopped selling and started buying. Today, we are walking through all of it. What caused the crash? What is powering the recovery? The exact support and resistance levels you need to have on your watch list, and where the thesis points 6 months from now. Buckle in, because this one is a full masterclass. Now, before we talk recovery, we have to talk about the crash, because understanding the panic is what makes the opportunity so undeniable. In the first 3 months of 2026, Microsoft lost 1/5 of its entire market value. Let that sink in for a moment. One of the most dominant, most predictably profitable companies in the history of the stock market, down 20% in a quarter. The headlines were vicious. Analysts were openly throwing around the phrase software winter. Investors were asking loudly whether the entire artificial intelligence investment cycle was a capital destruction machine dressed up in buzzwords. And here is the question that almost nobody was pausing to ask in the middle of all of that chaos. What if the panic itself was the trade? What if the fear was the signal, not the reason to run? Because while retail investors were hitting sell, something very quiet and very deliberate was happening on the institutional side of the market. Positions were being built, calls were being purchased, and the underlying business, it was not just surviving the narrative, it was accelerating through it. Which brings us to where we are right now. As of this session, Microsoft is trading at $411.34, up nearly 5% in a single trading day. For a company carrying a multi-trillion-dollar market cap, that kind of single-day move is not a blip. That is a violent, decisive repricing event. That is the market waking up and saying, we got this wrong. When you see a company of this size move 5% in one session backed by real volume, it is not retail FOMO driving it. It is institutions repositioning, and when institutions move, they tend to move in the same direction for a while. We are seeing 3 massive forces converging simultaneously right now, and when that happens at a critical technical level, the results tend to be anything but subtle. So what is the primary engine behind all of this? Let us start with the number that broke every expectation on the street. While the critics were publishing their AI winter takes, Azure was quietly engineering an absolute landmark quarter. In the second quarter of fiscal year 26, Microsoft's cloud revenue grew at 39% year over year. That is not a typo. In an environment where every macro narrative was pointing toward enterprise spending freezes and budget tightening, Azure grew at 39%. But the real jaw-dropper is this. Quarterly cloud revenue crossed $50 billion for the very first time in the company's history. $50 billion in a single quarter from cloud and cloud-adjacent services alone. To put that in perspective, that is more than most Fortune 500 companies generate across an entire calendar year of operations. And what this number actually tells us goes far deeper than just big revenue. It tells us that enterprise cloud migration, the core thesis that has powered Microsoft's growth for the last decade, is not plateauing. It is not hitting resistance from macro headwinds. It is actively accelerating. Companies are not pulling back on cloud spending. They are leaning into it harder. And Microsoft, through Azure, is the primary beneficiary of that structural shift. But cloud growth at this scale does not happen in a vacuum. It requires physical infrastructure. And Microsoft's infrastructure build-out right now is nothing short of extraordinary. The company just secured 3,200 acres in Wyoming specifically for a major data center expansion. Simultaneously, they have leased 30,000 NVIDIA GPUs in Norway. Now, why does this matter so much? Because right now, and this is the single most underappreciated dynamic in the entire AI investment story, the primary constraint on AI revenue growth is not demand. Demand for AI compute is essentially infinite at this stage. The constraint is physical capacity. The world does not have enough data center space, enough chips, or enough power infrastructure to deliver AI services at the scale that enterprise customers are requesting. Microsoft is not sitting around waiting for the market to build that capacity. They are going out and buying the land, securing the hardware, and constructing the physical foundation of the AI economy before their competitors can even map out a competing strategy. Ask yourself honestly, could any other company be executing this kind of global land grab at this pace while simultaneously maintaining enterprise relationships this deep? That is not a rhetorical question. That is the core of the investment thesis. Now, Smart Stock Sam does not do one-sided hype. There is a real, legitimate debate happening on Wall Street right now, and you deserve to hear the full picture. On the bull side, the Windows E7 suite drops on May 1st, alongside the new Agent 365 productivity tools. These are not marginal product updates. These are expected to be major, high-margin revenue drivers across Microsoft's entire enterprise customer base. And that catalyst is sitting just weeks away on the calendar. On the bear side, however, Microsoft has guided for $120 billion in capital expenditure this year. That is a number that gives even the most enthusiastic long-term bulls a moment of pause. Layer on top of that the recent departure of the president of the developer division, a signal that not everyone in Redmond is aligned on the current direction, and you can understand why some traders are keeping their position sizes disciplined. The fundamental question that every Microsoft investor needs an honest answer to right now is this: is this level of spending a visionary move that builds a competitive moat so wide that nobody can cross it? Or is it a margin erosion event that is going to take years to justify? The street is genuinely split, but the technical picture is anything but ambiguous. Let us go to the chart, because this is where the story really crystallizes. The May CD is showing powerful, sustained upward momentum. No divergence, clean trend confirmation. The stock is sitting right on its $409.46 pivot point, which is now functioning as a new psychological support floor. But here is the one thing I want you to memorize before you even think about entering a position. The RSI is currently reading 84.98. That is not just overbought. That is deeply, historically overbought territory. What that means in plain English is that the stock has run very hard, very fast, and it would be completely normal and actually healthy for the long-term trend to see a short-term breather or pullback from these levels before the next leg higher begins. Do not chase the current price. The setup I am about to give you is built around that pullback. And here is the macro technical picture that tells you the bigger story. The price has sliced violently above both the 50-day and the 200-day moving averages in what traders call a fast bullish crossover. This is one of the most decisive technical signals a stock can produce. It means the bearish structure that defined the Q1 drawdown has not just been challenged, it has been completely erased. When institutional money stops selling and starts aggressively accumulating, this is the fingerprint it leaves on the chart. The trend has changed, not changing, changed. And the analyst community is essentially unanimous in agreeing with what the chart is saying. 34 of the top analysts covering Microsoft right now have an active buy rating. 3 are at hold. And the number with a sell rating? 0. Not one professional analyst covering this stock is telling clients to get out. The price target range is equally striking, The lower bound sits around $556. The median 6-month consensus is $600, and firms like New Street Research have targets as high as $675. This level of conviction, coming right on the heels of a 20% decline, is extraordinarily rare. It tells you that the people doing the deepest, most rigorous research on this company looked at the sell-off and saw exactly one thing: opportunity. The derivatives market is telling the same story. The put-call ratio currently sits at 0.33. For every one contract betting on a decline, 3 contracts are betting on upside. With over 4 million total contracts in open interest, this is not a speculative retail trade. This is deep, institutional liquidity with a very clear directional conviction. Short interest, meanwhile, is sitting at just 1.09% of the float. Nobody with serious capital is willing to bet against Microsoft right now. And then there is the trade that caught a lot of eyes recently. Representative Josh Gottheimer purchased up to $1.1 million in deep-in-the-money call options on Microsoft, specifically at the $320 and $325 strike prices, expiring in June 2026. I am not going to editorialize the ethics of that trade. What I will say is that when someone with access to high-level information makes a 7-figure, high-conviction bet at these specific strike prices, it sends a signal. Someone with a very informed view on this company's future believed the market was pricing it significantly below its real value. The market, it appears, is now arriving at the same conclusion. Now let us talk about what could go wrong, because no bull thesis is complete without stress testing the downside. Risk number 1. OpenAI is starting to diversify its cloud partnerships, including toward Amazon Bedrock. If Microsoft loses its perceived exclusivity on the world's most capable AI models, a key part of the Azure differentiation story gets complicated. Could the company that built the AI Moat end up on the outside of it? That scenario feels unlikely, but it is not impossible, and it deserves to be on your radar. Risk number 2. Both the FTC and the UK's Competition and Markets Authority are actively scrutinizing Microsoft's AI bundling practices. Regulatory action moves slowly until it does not. Risk number 3. Microsoft recently patched 165 security vulnerabilities in a single cycle, including an actively exploited 0-day. At enterprise scale, cybersecurity incidents erode trust in ways that take much longer to rebuild than they do to break. None of these risks are reasons to avoid the stock. They are reasons to respect position sizing and have your levels defined clearly, which is exactly what we are going to do right now. Here are the price levels. Hard support sits at $380, anchored by the 50-day moving average. That is the floor. If we revisit that level, it is not a warning sign, it is a gift. The optimal loading zone, the range where you want to be building or adding to a position, is between $395 and $405. Watch for any pullback into that range over the next few sessions. On the upside, immediate resistance comes in at $420, which lines up with peak call volume for the next 2 months. A clean break above 420 on meaningful volume is the signal that the next leg is confirmed. Short term, we are targeting $450 as the catalyst price heading into the April 29th Q3 earnings report. And for the long-term investor, the destination is $600. Why 600? Because Microsoft currently holds a $625 billion commercial backlog. That is not projected revenue, not aspirational guidance. That is committed, contracted, locked-in future revenue already sitting on the books. Pair that with deep artificial intelligence integration across the full 365 enterprise suite, and you have a business that is not just participating in the AI economy. It is the infrastructure the AI economy runs on. Every enterprise that signs a multi-year Azure contract, every company that deploys Copilot across its workforce, every developer building on Microsoft's AI stack, they are all adding to a moat that gets wider every single quarter. The question is not whether that moat is real. The question is whether you want to be inside it or watching from the outside when the market fully reprices what it is worth. Before the final take, this is important, and I mean every word of it. Nothing in this video is financial advice. Smart Stock. SAM is an educational channel. Everything I have shared today, the analysis, the price levels, the trade setup, is based on publicly available data and is purely for informational and educational purposes only. Please do your own research. Please consult a licensed financial professional before making any investment decisions. All investing involves risk, including the possible loss of your entire principal. Past performance tells you nothing guaranteed about future results. All right, the bounce is real. The growth is historic. The moat is wider than it has ever been. And the smart money is not panicking. It is positioning. The question is not whether Microsoft deserves to be on your watch list. The question is whether you are patient enough to hold it from wherever you enter, all the way to $600. And here is what I want to know from you right now. Do you think Microsoft's $120 billion capital expenditure bet is going to build the most dominant competitive moat in the history of enterprise technology? Or do you think it is going to weigh on margins for years and ultimately disappoint? Drop your answer in the comments below. I read every single one, and the debate in this community is always worth the scroll. If this breakdown gave you value today, please hit the like button. It takes 1 second, and it genuinely helps this channel reach people who need this kind of analysis. And if you are not subscribed yet, what on earth are you waiting for? Hit subscribe, ring the bell, and join the Smart Stock Sam family. I will see you in the next one.